The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources podcast.
Well, if you're an investor, you don't have to go very far before you're worrying about what on earth is going on. That's a question that's pretty common in the financial industry.
Right.
And what should you be paying attention to? Well, in the recent years, it's been the Magnificent Seven stocks driving the S&P, the NASDAQ, not so much the Dow because they're not much in the way of technology in the Dow.
Right.
I think they've got one company there. But what about looking at the other 493 companies that are in the Standard & Poor's Index? Should you be paying attention to them, and should there be an alternative benchmark that's much more representative of what is going on with business in the United States? What do you think, Perry?
It's a good idea to take a look at that, and it's a good idea to think about. If you take the Magnificent Seven out of the market, out of the S&P 500 index, you know what happens? What does the rest look like? And the fact of the matter is that the S&P 493 gets very, very old when you take out the Magnificent Seven. When you take out the seven huge tech stocks, the largest company on the list after that is Berkshire Hathaway. Berkshire Hathaway, who's essentially an investment holding company. They don't do anything but buy other companies, which Warren Buffett's very
run by two guys who are almost centenarians.
They are. They're both getting ready to click over to 100 years old. It's been around for a long, long time. And the next one in line is Eli Lilly, pharmaceutical maker, established back in the 19th century by a veteran of the Civil War. So they are very old companies. They've been innovative, of course, but they're all very old school. JP Morgan Chase is on that list. They made their name and became a household name before the founding of the Federal Reserve. So they've been around a long, long time, which means one thing, they've remained successful, but none of them is threatening to become $1 trillion corporation like the Magnificent Seven. They're not they don't have that kind of growth, and they never have. So it's a whole different sort of growth, and that's a double-edged sword. They're much less volatile. There's much less volatility in the S&P 493 than the S&P 500, including the Magnificent Seven, but that also means by definition there's significantly less growth. So you're going to get more stability, but you're also going to get significantly less growth. But I'm not sure it's bad for the index. I think that's pretty reflective of, if the S&P 500 is supposed to reflect the mega cap part of the U.S. economy, that's kind of the way it is. There's a lot of old line businesses that aren't exactly blowing the doors off earnings or growth, and then there's a handful of tech companies that are just knocking it out of the park. So I think that's a pretty good reflection on what's going on. It's just a matter of being cognizant that it is very concentrated, and that S&P 500 gain or loss is being driven by a handful of stocks, and the rest of the S&P may not be doing as well. Probably won't be doing as bad on the downside.
So that really leaves a problem as far as risk management is concerned, because you end up being overexposed to the most volatile issues, and with that creates an emotional response when drawdowns happen, because the
Correct.
Drawdowns are bigger, and nobody likes a big drawdown.
Yeah, much bigger. I'm just looking at the article. In 2022, the Magnificent Seven was down 41%. The S&P 493 was down 12%. So it's significantly more stable. But of course, on the recovery side, you're gonna make less. So it's a matter of what are you looking for. But that really is a risk management decision. Like I said, Don, you need to look at those together and think about what it is you're trying to do, and should you be looking for a fund investing to cut out the Magnificent Seven if you think we're in a time where you're going to have to preserve capital, or do you want to make sure they're part of your portfolio if we're looking for long-term growth, or medium-term growth anyway, and see which one of those two things that you need to, which of those two you need, and it's important to understand that they're going to be very different.
And they're going to respond differently to Fed actions. I mean,
Correct.
the entire market, we can kind of ask the question, is this time different? That question's been asked a lot since the pandemic has shown up, with
Correct.
three consecutive years of negative returns in bonds. Because it used to be, to avoid volatility, you would
Right.
increase your bond exposure. But now we see that bonds have as much volatility as stocks. So we didn't really get the safety that was assumed to be there by diversification into a different kind of asset class. So if
Right.
bonds have similar volatility, then the question is, where do you go now if you want to stabilize your portfolio? And that is part of the reason that active management is back as a priority within financial services, because the Ron Popeil strategy, set it
Right.
and let it go. I mean, set it and forget it. It just isn't working when you have the kind of uh, unexpected results when news breaks. So there has to be a disciplined process in selection, in diversification, and monitoring to
Right.
preserve capital and to step back into markets when they rotate. And in the
And that's
past,
that's one of
basically,
the that's one of the big issues, Don. You're right. Is that rotation is so significant now, both driven by headlines and by market disruption because of the tech companies' innovation, and they're going to have something new that pops up that nobody's ever seen before. It's going to get immediate traction, and it's going to change the way that sector of the market is reflected in market value, and things change so fast that you need to be able to move with those and make those adjustments to your portfolio. And if you're in that broad-based pie chart portfolio where you're just going to buy a little bit of everything based on historical returns that go back 100 years, which now have no reflection on what's going on in the economy today or the market today, or what's going to be driving returns in the future, which is the key. What's coming up, not where have we been, because the direction the markets are going has never changed faster than they're changing right now. We've had huge shifts in the market all through the history of the market. We've never had changes that happen as quickly as are happening now, because of the everything being online. Those changes don't have to go work through a supply chain. They're reflected immediately, and that's been already that's been the case for a number of years now. And it's just everybody's getting used to the market changes quickly. And if you're just sitting there waiting for the market to come back around to what your asset allocation is, you could be waiting a long time. And you could also be taking a huge hit to your portfolio in the meantime. And that's what we think is important to try to mitigate as much as possible. We do that by tracking prices. We don't care about anybody's story. Tell me what the price is. If the price is really significantly changing up or down, that tells us where we need to add more, or maybe reduce some exposure because of what's going on to the price, and make adjustments based on that. And that's the best thing we found to track.
price is the only thing that pays. The
Yeah,
story doesn't. And a classic case, as you bring this up, just comes to mind, and that is the story about lithium. We go back just a
sure.
few years, and lithium was going to change the world. The demand for lithium in electric vehicles, in all of the
Right.
new electronics, that was going to change the world. But go back and look at the stock prices on lithium or the ETF LIT, and you would not be a happy camper in recent
Right.
years, because in spite of demand, those prices on those stocks have been falling. So it's not the story, it's paying attention to the price. Every industry has always had a cycle. There's a demand for it depending upon whether you're in a growth period, a recession, or a transition period.
Sure.
Stocks at the bottom of a recession is a period of time where you want to anticipate growth is coming, but growth doesn't come in all industries simultaneously. You get utilities that are typically doing well at the bottom of recessions because they're stable dividend generators. However, recently, even that story is not true. The prices have been falling. Utilities have had difficulty because they're highly dependent upon financing and interest rates being high after a decade of zero interest rate
Zero.
policy.
Yep.
Their utilities are under a great deal of financial pressure, as are many of the banks. Um, Banks typically earn money, more money at higher interest rates, but higher interest rates cause borrowers to have difficulty repaying loans. And son of a gun, the banks think they should be paid back.
What do you know?
Unless,
Yeah.
unless it's the government lending you money, they don't care. I mean, they'll lend you money and you can default, and they'll just say, well, we'll we'll take it under advisement and forget about it. Student loaning case, and some of the dumb investments that they made in solar field, where they basically, in retrospect, were buying off political donors to help them with their factory, which survived a year or two and then was.
Collapsed. Yeah. Right.
But some of the normal assumptions that you'd make by looking at prior economic cycles are totally different. They've been compressed, and you need to have a process to identify the transition from paying attention to accumulate to paying attention at the top, so you don't go through the period of distribution where stock prices are falling and your choice is to give up your gains or to do something about it, which means you're going to have to pay attention or hire somebody who does.
That's
has
it.
a rule to actually exit the market, because buy and hold with these new technologies penetrating industry. And actually, the biggest impact on technology isn't the Magnificent Seven, it's the way industry is operating. And Perry, we were talking about, I believe you said it was the robots that Elon Musk has
Yep.
developed in his factory. Let's give us a quick summary of that.
They're just making the advances are coming so fast. It used to be, well, here's a robot, it's got very good manual dexterity, if you will, but you have to program everything it does. And now they've advanced sufficiently to the point where the robot internally will understand what it can do and what it can't do, and it just needs instruction on what to do. And so you no longer have to program them for a specific task. You just have to tell them what the task is. So there's a huge difference between needing to define how to do something to a robot and just telling the robot, no matter what it looks like, if it looks like a humanoid or not, here's what it is we need to have happen. And then the robot will figure out how to do it. That's artificial intelligence coming online with it. And so that drastically decreases the amount of time it takes to put those robots online. So after the initial cost of purchasing a robot, labor costs drop to zero. They cost virtually nothing to run. They're not expensive to operate or maintain, for that matter. And they're coming very, very quickly. And so that portion of manufacturing is going to get easier and easier to engage. And as the cost of labor drops, we're going to need to be thinking about in the future, what are all the people going to do? It's going to be something different, because that's already here. That's already baked in, the ability to have robotic labor at a very high level, doing very high level assembly or dangerous jobs, things that we can't do. But what they're able to accomplish now, independently of human programming, just by being told what a task needs to be, even their eyesight's way better. They can look at something and be told, sort these out by color, say, and they can do it quite easily and don't need to be told what the color is, or just say, hey, put all the blue ones on this side and all the green ones on the other side. They're done. It's going to happen. And so that sort of advance is going to increase profit margins, is going to increase the availability of technology to penetrate many, many, many more fields where they're not right now. They're unable to be there. And then other fields that are just knowledge based. There's already tons of AI doctor sites out there where you're going to talk to a artificial intelligent database about your medical issue. Attorneys, almost every large law firm in the country now has AI to investigate issues because they can do 100 years of research in 10 seconds instead of 10 months. And it's significantly different. And those are already baked in. Those aren't coming. Those are here. And so it's just a matter of market penetration for those to really show up. And those changes are going to happen fast, and they're going to happen to all facets of manufacturing and production of anything, even knowledge-based production in the United States.
Which really poses an interesting question about what happens to labor. We know labor costs drop
Yeah.
for the factory or the company because they don't have benefits. They have some periodic maintenance they may have to do on a robot,
Correct. Yep.
but they don't have sick leave, they don't have vacation leave, they don't have workman's comp. There's a lot of stuff that goes away. They don't have to buy health insurance for them or a pension plan, either one. Now, that also means that somebody's not employed who used to do that job, or maybe 10 people who used to do that job are no longer employed there. We are going to end up with the problem of how do we educate another generation for productivity with something that they can do to support themselves,
Correct.
because we're not going to generate a government system that everybody's on the dole. We know those systems have failed everywhere they've been tried.
Only every time, though. Yeah, only every time so far. So yeah, not a good avenue to pursue.
We have millennia of cases where socialism has failed. There's never been a successful one. But be that as it may, I think that's a wrap. We cover a lot of stuff right here, and we plan on covering more in our next podcast. So subscribe. We thank you. You got questions about your own portfolio, there's contact information there. Give us a call. We'll be glad to talk with you. Have a great day.